What's going on, everybody? Welcome back to my channel. So I'm going to talk about something very, very important. Now, so many people want to take trades, or should we say traders want to take trades on a daily basis. But what they don't focus on is finding the best possible trading opportunities and scenarios. So we're going to go over 4 examples today, how to avoid taking trades in the wrong positions or market structure, should we say. So the first example we're going to take a look at is on gold. Now, we clearly know how market structure moves. We have a strong push face to the upside. We have a high structure here. We can see the break of this trend line, and we can see prices creating a level in the market where it's failing to break above. Now, this looks like an amazing sell opportunity because what we can see here is a really strong bearish candle to the downside. Most people at this stage will be super excited and gassed, getting ready to jump into this trade because they can see the candles to the left were much smaller in volume in terms of the ones that's just been created. And then what do? They take the trade. Now, let me just tell you, the reason why this trade is bad is because it's really bad. Now, we shouldn't just be focusing on single candles as traders. What we need to be focusing on is how the market structure is reacting to different key levels in the market. So as an example, we saw how price was reacting to this level. It wasn't able to break above, creating that double top. Now we can see once that double top was formed, we had that momentum shift. Once price broke this previous structure low, look what happened. The market came back to that level, retested, and then we had a continuation to the downside. Now we do have a continuation bearish structure to the downside, but what we're now finding ourselves facing is a level in the market where price may react to. And what we need to make sure when we're taking any trade, and most importantly management wise, is that we can get this trade to break even as soon as possible. We want to manage risk before reward. Once we get into the trades, we don't know if this trade is going to win or not, but what we do know is that if we get an opportunity to manage our risk, we live to trade another day. And as you can clearly see, our break even will be at this point because this is the area where price may find problems, and unfortunately we don't have that one-to-one. But we're going to take the trade because this is what I'm trying to illustrate on today's lesson. Make sure there's enough room to the downside or upside in order to take these trades. Don't just focus on the engulfing candle, the bearish engulfing. Don't just focus on the fact that the market's broken the trend line. You need to find that confluence, especially when it comes to risk management. And as I always say, risk before reward. Now, what happens when you take a trade like this, more often than not, you will find that the market will not break the structure immediately. The market will tend to sit around these levels for long periods of time. And this is the reason why you need this structure to be broken. If you're selling from these highs, your range is back down to this structure to get to break even. You're good to go. If you're selling this engulfing candle trying to break this structure, you're not good to go. And then eventually what will happen is you'll find the market will sit around the area, continue to range. It will stop you out at some of the key areas in the market where the price has come to before, where your best trading opportunities you will find will be at these levels, should I say. And then what happens? The market would eventually go in your direction. Okay, so what we have to make sure that we're doing is checking our range to make sure that we can get this trade to break even before we hit some key levels and find that the market cannot break these levels. Or you just wait for the market to come back to a key level. Patience is the name of this business, and I'm telling you now, those that can be more patient are the ones that are going to end up winning in the long run. It's not about the profits you're planning to take today, this week, next month. It's if you can survive till the end of the year and continually do this over and over again. So let's look at our second example. This is example number 1 on gold. So our second example on pound CAD is this structure here. Now, we've spoken about reversals yesterday and how to look for them. So if you haven't seen that video, there'll be a link in the description. But we can clearly see that the market structure is to the downside. This is the lower low, this is the lower high, this is the failure to break this structure, indicating strong bullish pressure. Now, what we're looking at here is a market structure that was sitting in around this level for about 4 hours and was failing to push to the upside or to the downside. Now we've had this really strong breakout of the structure, indicating this continued bullish pressure along with this confluence of price not breaking these structural lows. Now again, what most traders will do is they'll take this trade immediately with an instant execution, or they might buy the breakout with a buy stop or whatever else. Then they place their stop loss below this structure. But look again, if you look to the left slightly, you can see an area of traffic where there's lots of wick rejections, where there was an increase in sell pressure. Even if the market didn't tank 300, 400 pips, you see the increased sell pressure at this level. You can also see an increased sell pressure at this level, and look here, we cannot get a 1-to-1 risk to reward ratio to get this trade to break even, but we're going to take the trade because that's what we're here to do, illustrate how the market moves and what you need to be looking for. If you don't get that 1-to-1 risk to reward ratio, then this is a no-go trade. It doesn't matter what confluence you find, whether you see that price is not breaking the support level, resistance level, key level, supply, demand, I don't care what you call it, then guess what? Don't go for the trade, because more often than not, if you look here, you're going to get stopped out. Once you get stopped out of these trades, what's going to happen? You're going to find that the market's going to go in your direction, and everybody faces this all of the time. Whoa, that was a big candle. But the point here is we need to be focusing on making sure we can get this trade to break even as soon as possible. And the only time we was getting it to break even was once we were stopped out. So remember, risk before reward. Get this trade secured in. Make sure that you're not risking your profits for unnecessary reasons, because every time you take a trade, that's what you're doing. Make sure that the confluence lines up with good risk management and then go for the trade. Let's take a look at two examples that really will work in your favor. Example number 3, pound USD. Now, what can we see with this market structure? Well, look here. The market structure is pushing to the upside. We can clearly see that the structure is breaking previous structure highs, indicating this bullish pressure. Now, what we're seeing on this market structure is a depletion of this bullish pressure. This is a very good sign in a push phase market that the market may exhaust before a continuation up. If we take this trade, is it wrong? Absolutely not. Now, why is this different to the rest? Well, look here. Before price gets back to any wick areas where we might find traffic or any sort of retest levels, we're going to get that 1-to-1. And this is why we take these trades. Not because we're taking a reversal and we're playing a guessing game, because we have confluence that in a push phase market, when there's wick rejections and prices failing to break up, more often than not, we're going to have an exhaustion of this structure before a continuation up. Plus, we have this 1-to-1 risk to reward ratio before we get to any traffic areas where there's wick rejections and also retest levels. So now we can go for this trade. Now, again, I always say this on all of my videos. Do we know that this is going to win? No. But what we're doing is we're making sure that when we take these trades, we have the highest probable opportunity of winning it. And why are we making sure that we have the highest probable opportunity of winning it? Because that's how we make money in this business. It's a numbers game. So let's take a look at this. We've taken our trade and now we can see the market gets to our break even point. At this stage, what are we doing? We're locking this at break even. Why? Because the market could come back to this level now and we could bounce off at this level and continue to the upside. But does this matter? No. We're in a trade, we're risk free, and now we are ready to rumble. So whatever we plan to do, whether we plan to target these structural lows or whatever else, go for a 1-to-3 risk reward ratio, we just let the trade play out. And as you can see here, what happens? Okay, we finally hit take profit. But you see the difference with the two examples we showed on gold and pound CAD? We didn't have that break even range, which meant that the trade was a very risky trade. Here we had a break-even trade with added confluence, and now you can see we get that break-even trade and, in actual fact, a winning trade. Let's take a look at example number 4. Example number 4. What do we see here? Well, we can see that the market structure was clearly to the downside. We've had this break of this structure with this uptrend. Now, what are we identifying? We can see here that price is failing to break above this structure in a very strong push phase market. Likelihood is the market's going to exhaust before we have a continuation to the upside. What can we see? Strong bullish pressure into this key level and a depletion of that bullish pressure. So what are we going to do? We're going to take the trade. Everything lines up. Push phase market looking for the exhaustion, strong bullish pressure into a key level, now looking for that trading opportunity. We take the trade. Now, what do we need to monitor? Well, we need to make sure before price gets back down to these levels here that we have a 1-to-1 risk reward ratio to get to break even, because this is where the wicks lie and this is where we're more likely to face problems. So now we look for that 1-to-1 risk reward ratio. Do we care if the trade wins? No. Will we like it to win? Absolutely. But if it doesn't, it is what it is. Let's take the trade. Now we have a break even trade. What are we going to do? We're going to trail this to break even, and then we're going to go for a 1-to-1 or 1-to-2, whatever you want to go for, 1-to-3, should I say, whatever you're going to go for, and then you're going to see what happens. And what happens with this trade? Eventually we get stopped out break even. Okay, so this is the importance of making sure that you are managing your risk before your reward. If you do not have enough range to go break even, like we can see here on USD JPY, on pound USD, these are the two examples that did work. We had enough range to here, the wick area. We have enough range here on pound USD to the wick area. We did not have enough range here and we got stopped out. The market goes in our direction. And on gold, we did not have enough range here. For sure, we get stopped out and the market goes in our direction. So be sure to monitor this when you take a trade. Don't just look for confluence based on market structure and patterns and this and that. Make sure you're focusing on your risk, and trust me, the money will follow. I hope you've enjoyed this video, and if you have, please smash that like button, subscribe, and until next time, take care.